I'm going to also speak at eye level, if that's okay, not Alony Hetz eye level, but a foot shorter eye level. Thank you very much. I'm going to be short-ish, Motti, 30 minutes, and introduce our company, what we own, and what through Alony Hetz you all own, and then the business plan for what we have over and what we're going to develop and deliver over the next decade or so. Five topics in about 30 minutes. Who are Brockton? The three factors, in our opinion, that are driving strong real estate returns in the UK. It's no longer about cap rate shift as global interest rates got hammered down to midget levels. They're now rising. There are other factors that are driving strong real estate returns in the UK, which we'll touch on. We'll summarize our portfolio. And our portfolio is effectively split between two main divisions, what we call our workplace division, which is prime office locations in London, and then what we call our SRI portfolio, which stands for Science, Real Estate and Innovation, which is, as JLL Sean was talking about, is our life science portfolio within the Golden Triangle of Oxford, Cambridge and London. This gentleman on the right does not work for Brockton Everlast. This is the Chinese-American architect I.M. Pei, but like I.M. Pei, Brockton are always looking for angles and optionality and trying to extract the best value out of the assets that we own. So who are Brockton Everlast? As Motti was describing, we started in 2018, but we have been investing together, working together, and developing together in prior vehicles for many more years than that, around 16 years or so of total history in Brockton. We're focused on the Golden Triangle of London, Oxford and Cambridge. We have about 630 million pounds, so just a little under 3 billion shekels of equity capital. And as Motti and Nathan were talking about, we've been very recently joined by our new friends at Menorah Insurance. I'm very, very happy to welcome them into the shareholder group of Brockton Everlast. And as Motti said, we've got a longer history that spans approximately 20 million square feet, 300 buildings over the last 16 years or so prior to, over the 12 years prior to investing Brockton Everlast capital. Philosophically, who we are. This is our office in London. All of you are very welcome next time you're in London to come and visit us. This is a little fraction of our team. This is our website that launches next week. If you wait approximately 1 week, you will see our website live, and our philosophy is to both look at bottom-up asset-level returns and how we can drive strong real estate returns, but also top-down as we think about the macro moves that affect society, interest rates, real estate, zoning, and the space that is delivered across our key submarkets. In our view, there are three primary factors that are driving strong real estate returns in the UK right now. One is zoning, or what we call in the UK planning, same thing. One is stock selection, which has always been important. Stock selection has always been important. But when you think about the index of commercial real estate returns, in our view, we're not trying to be flippant or casual, but in our view, the index has become largely irrelevant. It's just a mishmash of different sectors that are diverging and going in such opposite directions that, as Sam Zell, the great real estate investor from the United States, says, the index is sort of irrelevant. It's like, which assets do you own, which assets do you need to avoid, and that's key. And then the third factor is net zero carbon and sustainability. First one, zoning. I'm not going to read this slide, but in very short form, the UK is a small island. Obviously, it's larger than Israel, but it's about the size of the state of Oregon. Imagine the state of Oregon in the United States with nearly 70 million people crammed onto it. Imagine the state of Oregon with a further nearly 40 million people visiting every year. And imagine the state of Oregon being the 5th largest economy in the world. And then imagine that zoning is really, really hard throughout the whole state. Land values are high, and there's a lot of value delivered through zoning. This photograph here on the left is the longest ever zoning battle in the history of the UK. It was nearly 10 years to get permission to build just another terminal at one of the world's busiest airports. And Brockton navigate the zoning process pretty well. Motti was talking about some of the boxing themes. You know, if Brockton was a boxer, our fight record in zoning would be 65-1. In other words, we have won 65 zoning applications over the history of the firm. We've only ever lost one, and that one that we lost, we appealed and we won. So we can add a lot of value through the zoning process. Stock selection. Where are you invested? Are you invested in assets that are wired and they're having a run-up? Are you invested in assets that are tired, that might cyclically be down, but might recover? Or are you invested in asset classes that, in our view, are just in a death spiral because of the changes in society? And unlike stocks and bonds that can go to zero, as Nathan was saying, with land, it doesn't go to zero, but it does resort to underlying land value. Unfortunately, and positively, Brockton Everlast are 100% focused on 2 out of these 4 sectors on the left, which is the top 2, life science and green, sustainable and flexible offices. And the question that we ask ourselves all the time is, how long and strong is this run-up in these 4 sectors? Because we're invested in the first 2. And in our view, we are in the early stages of an upward shift towards quality and prime locations where people want to be or have to be located in order to attract the right talent to drive their businesses, productivity, creativity, and collaboration going forward. The third factor that is driving strong real estate returns, certainly in the UK and in other parts of Europe, is net zero carbon and sustainability and the green issues. 2 slides here. This is the big picture. This has got nothing to do with real estate per se. You have the capital markets push towards sustainability. Larry Fink, one of the largest investment managers on the planet with only about $10 trillion of capital under management, is adamant that society and companies and management boards and CEOs have to be driving towards sustainability, certainly in order to attract capital from the likes of BlackRock and many other institutional investors. This is seeing a huge shift of capital towards decarbonization. And then obviously you have geopolitical factors as well that are driving, certainly in Europe, a need to wean itself off Russian oil and gas. The UK is less exposed to Russian oil and gas than the rest of Europe, but Germany obtains around 40% of its energy needs from Russia, and you can obviously see a huge shift towards decarbonization as a result of recent and current events. Now, if you drive down into real estate as a sub-theme within this drive towards decarbonization, you can see that institutional investors in the UK are very, very fixated on decarbonization. It is, in fact, the #1 issue for long-term investors in real estate in the UK, is are they investing in assets and portfolios that are net zero carbon or have the ability to be net zero carbon. And I won't read the words on the right, but you can see there's a lot of things involved in achieving the kind of standards that you need to hit in order to deliver green net zero buildings that will attract occupiers. But it's not just attracting occupiers, it's in obtaining zoning from local government authorities. It's in obtaining, it's in delivering net zero carbon buildings. It's in debt financing. Many banks will not lend unless your building is going to be highly sustainable. You won't attract occupiers, and certainly values and cap rates will be hit the wrong way. So for all these reasons, we're very excited about some of the themes that JLL were talking about earlier is in delivering the future buildings. Now let's come on to our portfolio. We own 9 assets, valued at about 1.2 billion. One of them is a small debt instrument with a fixed coupon on a high-yield development site, residential site in the center of the West End. I'm not going to talk about that one. It's less than 3% of our NAV, but I'm going to focus on the other 8 assets that are 97% plus of the portfolio. 4 of them are in London, and 4 of them are in the Golden Triangle between Cambridge and Oxford. We have around 40% loan to value. Nathan was talking earlier about debt and the need to be sensible and prudent to enhance return on equity through a capital structure that is deliverable and supportable from income streams, and that's what we have. Again, I won't run through the makeup of the income, but all the while that I talk about the development upside across Brockton Everlast across the next decade, just bear in mind that the portfolio is throwing off just under £40 million a year in NOI, in rental income, with the vast majority, around 2/3 of that income, coming from what we put in these green boxes. This is not Standard & Poor's or Dun & Bradstreet. It's just Brockton. Are they a strong credit or not? Will the investment market regard it as a strong credit or not? And about 2/3 of our income is what we regard from strong credits. This is our London portfolio, 4 buildings, 3 of which we think have big development optionality and upside over the next decade. I will talk to these individual projects a little bit later, and I'll pick out 2 of them, but you can see that they are located across different submarkets in London, all of them extremely close to major transport. There's a big article today on CNN.com, talks about the opening of London's, what they call Super Tube, which is the new Crossrail or Elizabeth line. 3 of these assets are located very, very close to this new Crossrail Super Tube. Number 1, number 3, number 4 are all located close. And then the second building there is midway between 2 other super stations in London, Waterloo and London Bridge. This is our portfolio in the Golden Triangle, the life science portfolio, if you like. 1 asset in Oxford, 11 acres. And this 11 acres, can't quite see from this aerial photograph, is exactly 1 mile from the main train station in Oxford, the main business school at the university, and we think has huge optionality over the next few years as the income expires. And then the other 3 assets are all located in Cambridge. This is our entire Cambridge portfolio in 1 photograph. We have approximately 25 acres, or Motti reliably tells me about 100 dunams of land, very well located, about 3 miles from the city centre of Cambridge, about a 10 or 12-minute walk to a brand new train station at Cambridge North. And then this is the northern part of the city's science tech cluster, and we are very well located with prime land for development and running income, both in the center of Cambridge Science Park, some of the metrics there top right, but also 2 freehold sites just on the entrance to the science park. And we think we'll be delivering over 1 million square feet of life science, laboratories, and high-tech office space over the next 5 or 8 years or so in Cambridge, which we're very pleased about given the shortages of space. Now, when we talk about the big picture overview, with Brockton. There'll be a lot of statistics and graphs and numbers, but I just thought I'd bring it back again to the asset level. About 40% of the increase in the net leasable area, and about half of our NOI projected NOI over the next 12 plus years comes from just these three schemes as examples, which is, I'll talk about them a little bit later, the two big development assets in London, and also the 10-acre block in the center of Cambridge Science Park that will be built in phases and have many buildings constructed on these 10 acres. And as I said, that's about 40% currently of the increase. I won't go through this chart in detail, but I would summarize it very simply. We're talking about a trebling of the floor area between the current owned portfolio. So this doesn't make any assumptions for future acquisitions. This just makes assumptions for what kind of zoning can we deliver over the medium term. So a trebling in floor area and around a 5x in NOI over this period. This is a 5x in IFRS NOI that smooths rent-free periods and other tenant incentives. On a headline level, it's even greater than a 5x. And that is essentially the business plan of Brockton Everlast over the next 5, 7, 10 years, is to deliver this portfolio and to keep also opportunistically buying new prime locations in our chosen sectors. The last sort of graphic that mathematically shows what we're doing here, again, I would summarize it by saying, if you go to the far right, you're talking about a all-in development cost, including our current all-in cost basis on the assets that we own, the future capex required in order to deliver them, and including also capitalized interest. You're talking about £3.7 billion of all-in costs to deliver a portfolio that we think will be throwing off or producing about a 6.6% yield on cost. Depending on how you treat interest, it could be north of a 7% yield on cost if you were doing this all equity, as many institutions do, and £245 million of income at, I don't want to make forward projections here, but if you go back to the JLL slides from 20 minutes or so ago, and you think about prime cap rates in the UK for prime locations, both in office and in life science, you saw cap rates there, either side of a 4 cap, 3.5, 3.75, 4. Pick your cap rate. If you're capitalizing those headline NOI at 245 million, you can see significant potential gains over and above the 3.7 billion all-in cost, and that is the business plan, as I said, of Brockton over the medium to long term. I'm just going to spend the last 5 or 8 minutes or so talking a little bit about what we own. I talked about and our strategy. The two main divisions of Brockton, as I said, split between our workplace London office portfolio and then our science, real estate, and innovation life science portfolio. So sort of unofficially around the office, we call our London office portfolio clean, green, and seen on design. What is design? Other than slightly funky word that rhymes with clean and green, design is design.com. Go and have a look at it. It is one of the leading magazines and websites focused on architecture, interiors, and design generally. It has over 50 million users go into design. And the point we're making here is that the office is no longer a commodity. The office is all about attracting prime rents and premium rents over and above other product. And in order to do that, you need to do 3 things. Your space, certainly post-COVID, but even pre-COVID, needs to be clean, needs to focus on wellness, everything from F&B to yoga, to touchless routes to your desk, air quality, air circulation. the building needs to have a net zero carbon commitment to it. That doesn't mean just planting trees in order to be net zero. That means driving down the embedded carbon in the projects that you are delivering. And whether it's JLL or CBRE or Cushman or any of the major global real estate consultants who advise on real estate, the biggest corporations in the world, the Fortune 1000, other private companies, you will not even be on a short list for these companies to consider your building in the UK if you don't have a net zero carbon commitment. And the percentage of buildings that are truly seen as sustainable is so small at the moment. You're talking like early single-digit percentages of office buildings in London that are seen as truly green. And what we're seeing is the demand for new space from the largest credits available in London is all coalescing around the tiny but growing percentage of buildings that are considered green. And as we deliver these buildings, we think we'll be attracting these kind of credits and prime rents. And lastly, the building has to have design qualities, amenities, and operations that deliver a great work experience for everyone who works in the company. And whether you're looking here in Tel Aviv at projects like Toha 1, Toha 2, and the other new buildings by Amot, it's a similar trend in London and in the States and elsewhere. Your building has to really differentiate. And if it does differentiate in a positive way, we're seeing the kind of NOI and income profiles that Sean from JLL was talking about 20 minutes ago, where you have a prime rent, an average basket of prime rents, and then you have the top rent buildings. And they've diverged. The top rent buildings are really pulling away from the basket if you deliver the right kind of space. This is the first major project that we'll be delivering in London this decade. It's the building here in the background, not the foreground. This is the Dovetail building. This is a CGI, an image of what the future building will look like. 23 stories, just under 500,000 square feet of net leasable area. Obviously net zero carbon, designed by one of the top architects in London. Great floor-to-ceiling heights. A great location. Very close to the new Supertube, as CNN call it, the Crossrail station, which is here at Liverpool Street. This, as you can see, is less than a 3-minute walk. It's on the edge of both the prime city tower cluster, but it's also close to Spitalfields and then Shoreditch, which forms part of the tech belt. And we think we have the optionality as we deliver this project over the next few years in talking to both financial, legal, insurance companies, but also tech and media businesses who are also increasingly coming into this area. Second potential development project in London. The first one that you just saw has zoning that's approved. We nearly quadrupled the amount of floor space that we owned on that prior slide. This building is slightly more conservative. We're talking about more or less a doubling of square footage, subject to receiving the zoning. This is called Telephone House, and it's in Shoreditch. And you can see there, sort of more or less located midway between the prime, sort of 10 out of 10 tech belt location at Old Street Roundabout, which is unofficially known as Silicon Roundabout in London, and Amazon's HQ next to the Crossrail station. So we're also very excited about this potential new project. And then lastly, a little bit of information and a summary on our life science portfolio. Again, informally around the office, we describe it as comprising of DNA, NIA, and ROE. In other words, what are the big picture drivers that are driving the demand for quality laboratory space in the Golden Triangle? How much net internal area can we deliver based on the land that we own? And then lastly, what is the return on equity as we deliver these projects? We're not scientists at Brockton. We are, if you like, hardcore real estate junkies, dirty fingernailed, as we describe it, bottom-up investing, but also with a view on the top-down. And we like to say that we've always had a view at Brockton, both on the shape of the yield curve, in the interest rate environment, macro issues, but also we've had a view, always very much had a view on the shape of the floor plate. Is it a good building? Is it a bad building? How can it be made better? How can the neighborhood improve, etc.? And recently, over the last few years, as we've been investing in life science, we are certainly also becoming familiar with the shape of the double helix. And you can see the fundamental drivers of demand across the UK that have opened up since the mapping of the human genome in 2003 was a really key moment in drug discovery. At the same time that the United States had finally mapped the human genome, at the same time, George W. Bush was banning stem cell research in the United States for moral or religious reasons, and that provided a big boost to the UK's position as a life science R&D hub. More recently, the UK's position as an R&D life science hub had been boosted by the discovery of the COVID vaccine by AstraZeneca, who are headquartered in Cambridge, in conjunction with the University of Oxford. So the big picture is very positive, we think, for the long run in terms of drug discovery, life science, research, funding over the next few decades. And this is, Motti asked me to point out, we are fundamentally not delivering things like, say, that Amot own, for instance, the Teva logistics facility. This is not manufacturing of generic drugs. This is not logistics and moving medicines around. These are the actual laboratories. This is, in fact, an asset that Brockton owned in Cambridge. This is the founder of a pharmaceuticals business in the lab that we own. And we think we can deliver high return on equity as we deliver quality laboratories over the next decade. This is the last slide. And what we did, this is sort of our research that we did, we just wanted to compare the fundamental position or picture of life science in the United States, which is obviously the key market for life science and R&D globally, versus the UK. And what we did is we picked 5 metrics. This is quite crude. We looked at the population of the UK versus the US, the GDP of the UK versus the US, the size of the life science sector in each country, the number of jobs employed in life sciences in each country, and then lastly, the number of universities that are in the world's top 25 universities just for life science and medicine. And you can see crudely, on average, simple average, the UK's life science sector market size is approximately a quarter of the size of the United States by these 5 metrics. And yet we only have around 6% of the built laboratory stock. The United States has a large and growing 170 million feet of life science laboratories spread across 12 main clusters, Boston being the most important. The UK has about 10 million feet of laboratories, primarily located in the Golden Triangle. And of that 10 million square feet, approximately half of it you couldn't lease if you were a life science or biotech business because they're occupied by universities or major research institutions. So the built investable stock of commercially owned life science is probably half that figure. It's about 5 million feet. And for that reason, not just for that reason actually, also looking at the latent named demand from actual named companies for laboratories, our view is that there is a structural, not a cyclical, but a structural undersupply, massive undersupply of laboratories in the UK, which is why we're very pleased to own the 25 acres in Cambridge and the further 11 acres in Oxford in order to deliver and meet this demand over the next few years. And Motti, for me, that was quite short.